Hi friends, welcome to the BFM Crash Course Unit number 18. Chapter name is BASEL 3 Framework on Liquidity Standard. So this entire chapter I have divided into 4 to 5 slides, and each slide I will convert mind map, flow chart which help you understand each and every concept. So let's get started with our first topic that we have. Ever wondered why BASEL 3 was ever introduced? What triggered it? And how it is different from BASEL 2. Let's decode the powerful transformation of the global banking regulation in simple and visual way. So let me zoom a little bit so that you can easily you can easily view it. So let's rewind to 2008. Right. So let's just wait a minute. Yeah. So let's rewind to 2008. What happened? The global financial crisis shook the world, shook the global economy. Right, world economy. BASEL 2 failed to prevent it. So BASEL 3 was introduced in 2010. Right. So with a clear mission to plug those regulatory gaps that left the bank vulnerable. What was the objective of the BASEL 3? So I hope the trigger point is clear now, that it was nothing but 2008 crisis. What was the objective of BASEL 3? To fix the loopholes which was in BASEL 2 by strengthening 4 key pillars. Yes, there was 4 major measures like capital adequacy, risk weight variability, leverage control, and liquidity strength. Let's talk about capital adequacy. So one of the biggest shift, capital adequacy jumped from 9% to a much safer 11.5% in the BASEL 3. Right, it is safe. It moved to the 11.5%. Plus new triggers were added, like if CAR dips below 11.5%, bank must conserve capital, or no dividend, no bonus, no payout back, no bonus payout, and even restriction on buyback. Right, all of this to push bank towards safe and responsible lending. So this is the point. And if CAR is less than 9%, then PCA, prompt corrective action invoked, possible narrow banking. Right, so these are the limits which have been placed. Now let's look at the reduced RWA variability. This was another smart move. BASEL 3 asked bank to reduce their dependence on internal risk model. Right, so what BASEL 3 asked bank? This is BASEL 3, and it asked bank to reduce their dependency on internal risk model. They should not depend more on the internal risk model. Instead, they use a standardized and consistent approach, right, for calculating risk weight asset. Use a standardized approach and a standardized and consistent approach to calculate the risk weight asset for, right, why? To avoid manipulation and to ensure transparency. Two words are there. First word is manipulation. They want to avoid manipulation, and second one is to ensure the transparency. For these two things, that the RWA variability has to be reduced. Then one more thing important is that leverage ratio was introduced. So BASEL 3 introduced a leverage ratio, a backup check that ensure that bank don't build up too much risk. Right, just now I told you that BASEL 3 asks bank to reduce their dependency on internal risk model. Instead, use a standardized and consistent approach for calculating RWA. Earlier, bank used their own model, but BASEL 3 tells bank to use a standardized model which is adapted across the world. So leverage ratio we have just talked about, that it is a backup check that ensures that bank don't build up too much risk even if they have high capital. Right, simple formula but powerful impact, that it prevented complex financial engineering from hiding real risk. It's like having a second brake in case the first one failed. That is called the leverage ratio. So the next point is strengthening the liquidity standards. Right, what does it mean when I say? So basically BASEL 3 focused heavily on liquidity. Right, the collapse of the Northern Rock showed how bank can run out of the cash. Right, so BASEL 3 introduced 2 key ratios. The first one was the LCR. What is the meaning of LCR? So when I say LCR, it means, just wait a minute, LCR means liquidity coverage ratio for 30-day, HQLA means high quality liquid asset for 30 days stress, and NSFR, which means net stable funding ratio for the long term strength. So that is the first slide we have just discussed. So basically this is the first slide which we have gone through right now. Right, let me show you a little bit about it. So physically, in short, BASEL 3 was not just an update, rather it was a total upgrade to the banking safety built from crisis, designed for the future. Now friends, let me take you through this particular mind map where everything regarding LCR is just shown in one picture. Right, this will help you give you a clear picture, and you can easily solve MCQs and case studies based on them after you have the concept. So liquidity is the lifeline of any bank, but what happened when the stress hit hard and cash dry up? Enter liquidity coverage ratio, or LCR, where this is your banking financial shock absorber. We can call them what this is this LCR is just like shock absorber. In one word I can say this is like shock absorber. Right, so let's break down the LCR framework in India, how it works, why it matters, and how it is implemented. First thing first, every bank must maintain LCR of 100% or more. You see this word, they must maintain LCR of 100% or more, right, all the time. This means they should hold enough high quality liquid asset, enough HQLA the bank must hold, right, to survive 30-day cash crunch. So to survive this 30-day cash crunch, they should have enough HQLA. And if this ratio drop below 100%, what will happen? Bank must submit a restoration plan, right, to the RBI immediately. So remember, LCR limit is 100%. Now what if there is a crisis? So let's talk about the stress. What if there is a crisis? See, yes, bank can use their HQLA and their LCR may fall below 100. Suppose there is a crisis, so bank can use their high quality liquid asset and LCR may fall below 100%. But here is the catch. What is the catch? They must report it promptly to the RBI, which is DBOD and DBS, which is the Department of RBI, right, along with the reason and how they plan to fix it. If you look at the scope of the application, so the LCR framework first applied at the standalone level. Remember, it was first applied at the standalone level, meaning each bank including its foreign branches. Eventually, the goal is to apply LCR at the consolidated group level, right? This is very important thing. The goal is to apply the LCR at the consolidated group level, and for foreign bank operating in India, LCR apply only to the Indian operation, that is the standalone. Remember this thing. For further goal is to apply LCR at the consolidated level, but for those bank, foreign bank which is operating in India, LCR apply to Indian operation only, not their foreign operation. Understood? Right, earlier it was just a standalone level, but for Indian bank that is consolidated level, that means both foreign branches and Indian branches should be taken into consideration. But for foreign bank which is operating in India, it should be a standalone level. These are the points from where question are asked, and everything I have compiled in just one line based on what we have observed in the past 3 to 4 years question paper. Now if you look at the formula for calculating LCR, it's quite simple. In the numerator you write the high quality liquid asset, that means you write the asset and you divide it by the net cash outflow, right, for the next 30 days, and the outcome must be always greater than or equal to 100%. So you can write it like this, it should be greater than or equal to 100%, the outcome. Now if you look at the implementation timeline in the left side, you can see that LCR was not rolled out overnight. It started from January 1st 2015. You see, it started from January 1st 2015 and it was gradually phased in. 2015 60%, 2016 70%, 2017 18%, 2018 19%, and 2019 100%, right? And if you look at the pandemic related election, so no rulebook is rigid. During the pandemic, temporary election were provided, but one thing is stabilized, full reinstatement kicked in, restoring financial discipline. So LCR is more than a number. It is a safety net, a guardrail that ensured bank remain liquid, credible, and resilient even in the most turbulent time. That is all you need to remember about LCR, right? High quality liquid asset in the numerator, and in the numerator what we write, HQLA divided by the net cash outflow in the denominator, right? Now friends, let's look at the next point. That means at least 30-day liquidity banks would have HQLA divided by the net cash outflow, right? Now friends, let's talk about when a crisis hit, and it should be greater than 100%, means HQLA should be greater than the net cash outflow for the 30 days. This should be the case, right? So how many times HQLA you have as compared to the net cash outflow, that is what it tells you, that LCR tells you. If you go deeper into the high quality liquid asset, let's understand. So basically, when crisis hit, what matter most is not just cash, it is convertibility. Yes, whenever crisis hit, what matter most is convertibility. Let me write it down. What matter most is convertibility, not the cash. Just let me write it, convertibility, right? And that is where HQLA or high quality liquid asset comes in. This is the crown jewel of a bank liquidity buffer. Let's decode what make an asset as high quality and why it is central to the bank survival during financial stress. HQLA, let me zoom a little bit so that it becomes very much clear to you. So HQLA, you can call them unencumbered, right? Let me show you. So they are unencumbered, easily sellable, right? And asset with minimum loss in the value, right? So they must quickly convert into cash, especially during a stress. You can think liquidity based on asset type, market depth, stress scenario, and conversion timeline. If you look at the fundamental characteristics of this asset, the first thing is that they have lower credit risk, very low credit risk. They have lower market risk, right? Very low credit risk, very low market risk, right? They should have very low credit risk, very low market risk, and obviously they should have easy valuation. That means reliable valuation. As you can see, they should be valued reliably, and also they should be low correlation with the risky asset, and they should be listed on the major exchange, adding to their credibility. These kind of assets should be listed on the major exchange. Now if you look at the market related characteristics, So from a market view, the asset must be actively traded in the large and deep market, right? And it should have committed market maker and low concentration, ensuring it hold its value even in a liquidity crunch. Low concentration and flight to quality in crisis. If you look at the classification of HQLA, so HQLA are grouped into three levels: the level 1, level 2A and level 2B. What is level 1? Level 1 is cash, or we call it near cash asset. Like they are highly liquid, they are convertible on day one with no haircut, right? That is called level 1. Level 1, you can take cash or near cash, right? And they are highly liquid, and they are convertible on day one with no haircut. What is level 2A? Level 2A means less liquid and 15% haircut is applied. And what is level 2B? They are even less liquid with higher haircut and tougher to convert, right? So they are convertible on day one with no haircut. That is the point. Now if you look at the composition rule, so HQLA, this is the rule book for HQLA mixture. So remember, basically what I am telling you, that level 2A asset, level 2 asset, which is 2A plus 2B, right? This should be not exceed 40% of the HQLA. Remember, level 2, which includes 2A and 2B both, right? It should not exceed the 40% of HQLA. And out of that, level 2B is capped at 15% of the total HQLA to avoid over dependence on less liquid instrument, right? So total HQLA, whatever high quality liquid asset, out of that 15%, suppose HQLA is 100 crore, 15% is 15 crore. So level 2B should be less than or equal to the 15 crore. This is the maximum cap. Level 2B cannot exceed that, right? So why? To avoid over dependence on less liquid instrument, right? We should not depend more on the less liquid instrument. That is why this cap has been kept, because obviously it is less liquid. That is why cap is given. And for level 2, it should be less than 40%. It should not exceed the 40%. That is the why level, because level 2 is less liquid as compared to level 1. That is why we should not include more less liquid instrument into our composition. That is why this rule is there. Now if you look at the diversification requirement, this is the golden rule: no concentration risk. Means especially in the level 2 asset, bank must diversify by issuer, asset type and counterparty. So the next time you hear liquidity cushion, think beyond just holding cash. It's about holding the right kind of asset, that is HQLA, that protect bank in the eye of financial storm. So that is as holding HQLA. I hope that makes sense to you. Now friends, let's switch our focus to the NSFR, right? What is NSFR? Every aspect of NSFR is provided in one single PDF. Imagine a bank that looks strong today but collapse tomorrow due to unstable funding. To prevent such a scenario, we have net stable funding ratio, the financial backbone of a long-term stability. Let's unpack the NSFR framework, right, which ensure that banks don't just survive, they thrive with sustainable funding. So this is the basic formula of NSFR. You can see on the left top side, ASF upon RSF, right, where ASF is the available stable funding and RSF is the required stable funding. This ratio must be 100% or more at all time. Like in LCR, we see LCR was more, 100% more. Similarly, this ratio should be more. That available stable funding should be greater than the required stable funding. So what is the definition of a stable ASF? Let's look at the top right corner. ASF, you can see it here. Let me highlight it. This definition. So ASF, ASF include a stable capital, right, and liability expected to remain for more than 1 year, right? Because source of fund, here we are talking about stable funding. So funding is what? From where we are getting the fund. Obviously fund is generated from what? From liability. But from where bank is getting fund? From capital or borrowing or liabilities. Many kinds of liabilities are there. That is called available stable funding. And RSF is the required stable funding. So RSF depends on the liquidity and the maturity of the asset and off balance sheet exposure. How much RSF always depend on the asset and OBS liquidity and maturity. So what is the goal here? What is the objective? Why we are discussing this NSFR? As you can see on the top right bottom corner, objective. Let's talk about the objective of this NSFR. The goal is to promote long-term funding. This is what we want. We want to promote long-term funding. I told you that we should have sustainable financing. We look at the tomorrow. That suppose our bank condition is good today, what about tomorrow? That is called long-term funding risk, right? To reduce it, to reduce the liquidity risk and to avoid reliance on short-term unpredictable source. That is our objective. So that is objective. Now if you look at the purpose and benefits, so in the top right corner, let me show you what are the purpose and what are the benefits of NSFR. So here you can see that NSFR provide a stable funding, right, for all balance sheet item, whether it is asset, whether it is liability, right, or it is OBS. So it provide a stable funding for all balance sheet item. It reduce excessive short-term fund reliance and it improve the funding risk assessment, right, making the bank fully resilient. If you look at the timeline of implementation timeline, so on the right side you can see, so NSFR, though NSFR was originally proposed for 1st January 2018, but due to COVID-19 it leads to delay. It was finally implemented on 1st October. If we look at the applicability on the left side, so this framework is applied to both the Indian bank, both solo and consolidated level, and foreign bank branch in India on a standalone basis, right? And if you look at the supervisory oversight, so NSFR is monitored using a supervisory review, right? Ensuring that bank prioritize funding stability and tackle liquidity risk head on. So basically, liquidity ensures survival. So what is the moral of the story that we have just understood? That liquidity ensures survival, but a stable funding ensures strength. While with NSFR in place, banks are no longer walking a tightrope. They are building a bridge to long-term trust and confidence. If this video help you understand the concept, please hit that like button. And if you want to enroll in our crash course, in which you get such kind of PDF for each and every unit that will help you revise the entire content quickly, and also you will get sufficient MCQs and quizzes for practices along with that. And not only that, right, you will also get previous year questions, some capsule content also. So you need to WhatsApp me on this particular number. Please save that number, or just you can see the description section of this video. There also the course detail has been given. Now friends, let's understand FALLCR. What is FALLCR all about? Just now we have discussed the NSFR. So friends, what happened when a bank run out of its top tier liquid asset during a crisis? Enter the safety net, that is called FALLCR, a strategic liquidity lifeline during extreme stress, right? Tier 1, tier 2, we have just divided high quality liquid asset, level 1, level 2, right? Now in this segment, let's decode FALLCR, or facility to avail liquidity for liquidity coverage ratio. The full form of FALLCR? Facility to avail liquidity for the liquidity coverage ratio, right? Remember, it kicks in only after all other HQLA are exhausted. So that is the eligibility criteria. It provides additional liquidity support, right? It provides additional liquidity support using eligible government security, but it kicks in only when all other HQLA are completely exhausted. It is the emergency backup, not the first line of defense. Remember, it is emergency backup. The first line of defense is the LCR. HQLA part, level 1, level 2, that we have discussed already. If you look at the key feature, it is a stress only tool activated under the crisis, permitted through RBI 2014 circular. Bank can use FALLCR only after fully utilizing their MSF, marginal standing facility, and SLR eligible asset. This ensures a disciplined and phased utilization of the liquidity buffer. If you look at the haircut here also apply. So you can see haircut as per the MSF guideline is applied. Tenor is up to 90 days, and rate is 200 BPS above LAF repo rate, right? For up to 90 days or as specified by RBI. So it is supportive but not the cheap. Now if you look at the level 1 HQLA, just look at it. Here is where the things get interesting. What are they included in level 1 HQLA? Let's see. So level 1 HQLA includes SLR plus security under MSF, right? SLR plus security under MSF 2% NDTL plus SLR under FALLCR, which means 9% NDTL. So FALLCR extend the pool of asset eligible for LCR. That means it strengthens the liquidity resilience. So you can see it includes a level 1 HQLA include SLR plus security under MSF and SLR under FALLCR. Now if you look at the valuation requirement, all security used for LCR, including those under FALLCR, must be valued at the current market price. They should be valued at the current market price, regardless if they are under HTM, AFS or HFT. We have already covered this HTM, AFS and HFT in our live session. We have discussed numericals based on them. So what we have discussed just now is that FALLCR is not just a backdoor option. It is a strategic liquidity reserve built to reinforce confidence during the financial storm. It's it's like last mile fill that ensures that a bank keep running even when everything else is dries up. Now friends, let's look at this particular table, very important table, and questions are asked based on this table. That's why I have put it here. This is about Basel III liquidity return. Ever wondered how bank prove that they are liquid enough to survive a crisis? Not just once, but every month. Welcome to the world of Basel III liquidity return and available stable funding factor, the behind the scene check that keep our banking system rock solid. Let's begin with a mandatory requirement that bank must submit under the Basel III norms, collective known as BLR, that is called Basel III liquidity return. The full form is called BLR. Let me show you. This is called BLR. So the first thing is LCR return. You can see LCR, that return, that is BLR1. This is the liquidity coverage ratio that is filed monthly within 15 days, right? Then we have BLR2, which is funding concentration. Remember it, right? It is also to be filled monthly within 15 days. Then we have the unencumbered asset, that is the BLR3, right? It is quarterly, it is reported quarterly, and basically it tells RBI that which asset can be really solid, right? And it is done quarterly. Then we have BLR4, which is LCR by significant currency. It shows if liquidity is maintained in every major currency or not, right? If liquidity is maintained in every major currency or not. And then we have other liquidity information in BLR5. Any extra liquidity data that RBI want, also monthly it is done. So the key takeaway is that the RBI keep a tight watch with report due. We see maximum case there is 15-day report, only 2 cases 1 month report, that is BLR3 and BLR4, right, depending on the type. Now friends, let's look at the next section. This table you must keep by heart it, right? When it is monthly, you can see the maximum case it is monthly frequency of submission, but only BLR3 it is quarterly, right? And here it is month. So this way you can remember it. Now friends, let's look at this particular table, super important. So let's dive into how this available stable fund, that is called ASF, how this ASF is measured, critical for the NSFR. Obviously, how to measure this ASF. So the table categorize liability based on their stability and assigning a weight, that is ASF factor to each. Because because stable funding is always about the liability, right? So which kind of liability should be assigned 100%, and how much ASF should every liability be assigned. So the first case we have is the 100% ASF. As you can see, what are included here, you must know it. Just wait a minute, let me show you. So under 100% ASF, what are included? So total regulatory capital, first thing, long-term borrowing, right, over 1 year, you can see maturity of 1 year or more, these are 100% ASF. Then we have 95% ASF, which means retail term deposit with maturity over 1 year. You can see retail term deposit with maturity of over 1 year, that is 95%. What about 90%? So is it a small business term deposit over 1 year, right? A small business term deposit over 1 year, you can see that is 90%. Then we have 50% ASF, like funding from corporate or financial institution, right? If we talk about 50%, then funding from corporate, other financial institution, even a stable deposit can carry moderate risk here. Then we have 0% ASF. So unsecured, you can see which cases having 0% ASF, like unsecured wholesale funding, right? Unsecured wholesale funding under 6 months, short-term borrowing from financial institution, derivative, trade-related payable, and non-stable source. So what does this mean? That the longer and more detail-oriented your funding is, the more reliable it is in liquidity crunch. So remember it, right? So in the last case we have seen that unsecured wholesale funding under 6 months, they have 0 available stable funding, right? So basically the rule is that the longer and more detail oriented your funding is, the more reliable it is liquidity crunch. That is point. So these reporting norms and ASF weight ensure that bank don't just chase deposit, but focus on long-term, stable and diversified funding. Because when a storm hit the financial system, it is not about who has the most, it's about who built to last. Then look at this particular table. When a bank lend money or invest, how risky is that from a liquidity perspective? So Basel 3 answer this by assigning RSF factor to every asset. Here you will see RSF factor. So whenever bank lend money or invest, how risky is that from liquidity perspective? This is done by RSF. Let's explore what made an asset more or less stable. Asset. Last page we talk about liability stability. Here we are talking about asset stability. So first case we have is 0% RSF. You see which case is having 0% RSF, like extremely liquid, right? So no stable funding is needed for that, right? Like coin and banknote, cash reserve ratio, right? All RBI balance and claim within maturity 6 months, they are extremely liquid, highly liquid. So there is no requirement of a stable funding, right? So for these assets no stable funding is required. Then we have 5% RSF, low risk, minimal stable funding needed, like level 1 asset like government security, CRR and unencumbered SLR security. Then we have 10% RSF, right? Like some SLR encumbered is a security encumbered, loan to bank maturing in 6 months, right? Then we have 15% cases, so loan to financial institution with maturity under 6 months, right? Then 15%, then 50% you can see. So 50% unencumbered level 2B asset, right? So and other loan maturing in 6 months to 1 year, right? They are under 50%. Then we have 85% case, right? This question was asked last time. 65%, right? So 65% case is you can see unencumbered standard residential mortgage with a residential maturity of 1 year and with the minimum risk weight permitted under the standardized approach. Remember, this is 65% RSF, right? Then we have 85% RSF for a standard loan to customer maturing in more than 1 year, right? Other unencumbered performing loan with risk weight greater than 50%. So you must know this. and 100% RSF is for all other asset not mentioned above, and including high risk retail or SME loan or loan to NBFC, and 100% RSF. So friends, the RSF framework pushes bank to fund long-term and illiquid asset with equally stable resources. The deeper the risk or the longer the wait to recover fund, the higher the RSF factor. And that is how BASEL ensure that bank don't run dry when market go dry. Right. So that is all we have discussed. 66% we have seen. So home loan with decent credit profile and sound documentation, they have 65% RSF. Just now I told you. Right. Then we have 85% RSF for derivative transaction. Right. Margin requirement, cleared risk exposure to CCP. Right. Also loan with higher risk weight under standardized data. So just go through it. Right. We have discussed it. So RSF scale like a risk mirror. The longer, riskier or less liquid the asset, the heavier the stable funding needed. This ensures bank remains solid even when a storm hit the financial stage. So the longer, the riskier or less liquid the asset, the higher the RSF. So that is all you need to know about this particular topic. Nothing extra. Just go through it. Just solve the numerical and keep